Hello, everyone. My name is Nathan Corey, and I'm joined today by Dan Brown from Richardson Capital Management. And we are here with our economic and investment update for the month of January 2024. Well, Dan, after a strong performance in the financial markets to end 2023, we started the first month of January 2024 with a little bit more of a mixed returns on the financial markets. We saw some sectors post some modest gains, others with actual modest decline. In fact, we saw the S&P 500 this month reaching a new all-time high. Do you want to shed a little light on what we saw in some of those different sectors and kind of what we see going from here?
Sure, Nathan. So, from a sector leadership standpoint, to begin the year in 2024, kind of similar to what we saw for most of last year, in that fairly narrow leadership with a couple sectors really providing most of the gains. So, for example, information technology and communication services led the way higher for the month of January. Again, that was kind of a repeat of what we saw last year, and a lot of other sectors posting slightly negative returns. But as you mentioned, that was strong enough to push the S&P 500 to a new all-time high. On the fixed income side of the ledger, kind of flat, muted returns. Interest rates for the first couple weeks of the month rose a little bit, but then declined towards the latter part of the month. So we think that we've kind of peaked as far as interest rates are concerned. They reached, the U.S. 10-year reached about 5% in October. We think those highs are kind of in for interest rates, and they could trend a little bit lower throughout the year, which we'll talk about a little bit when we talk about the Federal Reserve.
Sure, got it. And Dan, as we continue on into 2024, one of the key focal points for investors has been the strength and resilience of the economy, especially in the face of higher interest rates and stubbornly high inflation. We actually saw a relatively strong GDP print late in the month in January, kind of surprising the expectations. You want to shed a little bit more light on kind of what we saw in the economy so far for this year, and what that's kind of meant in terms of inflation and employment trends and
Yeah, as you mentioned, Nathan, I think resilience is a great word to describe the U.S. economy. Because if we back up a year and look at a lot of the projections from economists and strategists, a lot of them were projecting for the U.S. economy to, at some point in the year, enter recession, and we didn't get that.
right.
So, as you mentioned, fourth quarter GDP came in last week and it surprised meaningfully to the upside. So, expectations were about for 2% growth in the quarter, and we actually saw the U.S. economy grow at a 3.3% clip. So very strong. For the full year, about 3.1% for the U.S. economy. And if we dig a little bit deeper into the fourth quarter, we see that consumer spending really propelled the economy higher. Consumer spending is about two-thirds of the economy, and that grew at about a 2.8% clip. So the graph that we're showing here, the blue bars represent the quarter by quarter GDP, and the gold line is consumer spending over time. And I guess we shouldn't be too surprised that consumer spending has remained strong because the unemployment rate has remained low at about
hmm
3.7%, and it's been below 4% for quite a while now. Real wages are finally rising as inflation comes down, and there's plenty of job openings. And then if we look at another component of GDP, that would be business spending. And we saw all four quarters of last year, 2023, be positive. So we take that as a positive sign as we enter 2024 for the U.S. economy to continue to grow.
Got it. And Dan, another key event in the month of January was the meeting of the Federal Reserve at the very end of the month. And while nobody really anticipated a change to the Fed funds rate at this meeting, what did surprise some investors was the messaging regarding future rate decreases, with many investors expecting maybe a March timeframe as being the earliest for a rate cut. You want to talk a little bit about kind of how that shifted after this meeting, kind of what we're seeing going forward, and maybe a little bit about the uniqueness of this situation, and that we're facing a period where we're anticipating the Fed to reduce rates in a period where we are seeing economic resilience,
Right,
and
right.
rather than trying to propel the economy, we're kind of coming from a good spot.
Right. So just backing up a month or so, we ended 2023 with investor expectations that the Fed would begin cutting interest rates as early as March. And as we talked about in our investment letter and on this video, we thought that was a little bit too early.
Right.
And that was one reason why the financial markets performed as strongly as they did in November, December. So we thought a lot of that optimistic outcome with the Fed cutting interest rates in March propelled financial markets higher in November, December. So we saw a little bit of a pullback in the financial markets in the month of January, and specifically on the day that the Fed had their meeting. So they indicated no change in interest rates. So we're going to, have Fed funds interest rates be that in that range of 5.25 to 5.5%, which is what we expected also. But yeah, the tone was meaningfully different with Fed Chairman Jerome Powell indicating and hinting very strongly to the market and investors not to expect them to begin cutting interest rates as early as March. So we thought maybe June, July would be an appropriate time frame
Right.
for all the reasons you just mentioned, and that we talked about. The economy remains strong. Again, GDP was 3.1% for last year. Unemployment's low. Inflation's trending in the right direction, but it's still above the Fed's target. So their preferred target is 2%, and their preferred measure of inflation is at about 2.9%.
Mm-hmm.
So the good news is it's trending in the right direction, but the Fed isn't ready to cut interest rates just yet. So maybe expect sometime in the summer.
Well, Dan, as we've stated in the last number of videos, we've had a relatively cautious approach through most of 2023 and coming into 2024. As we see some of these, favorable signals on inflation, GDP, and the economy overall, how does that shift our focus going forward and kind of our approach on managing portfolios?
We've become more optimistic the last couple of months, mainly because we think that soft landing scenario is the more likely scenario to play out. So the soft landing just refers to the fact that economic growth and economic activity trends a little bit lower, but we don't go into a hard landing or a recession, and maybe we see unemployment rise very marginally. So as we talked about, unemployment's fairly low, under 4%. Maybe it moves up a little bit, like a 0.5% or so, and kind of levels out. So we're feeling pretty optimistic that we can maybe start to put some of the conservative approach that we took with money market and move some of those funds into traditional fixed income.
Sure.
So we think that interest rates could remain about where they are, or actually a little bit lower over the course of the year, which is a pretty favorable setup for traditional fixed income. And as we look at corporate profitability, we see that also remaining fairly strong, which should be fairly good for traditional fixed income.
Well, with that, we want to thank you for watching. Feel free to share this video with others if you think they might find it helpful. And feel free to reach out to us with any questions or concerns that you'd like to talk through. And as always, we sincerely appreciate your continued trust and support.